Welcome to Macro Hive Conversations with Bilal Hafiz. Macro Hive helps educate investors and provide investment insights for all markets from crypto to equities to bonds. For our latest views, visit macrohive.com. So greetings and welcome, Dominique. As usual, it's fantastic to have you back on the podcast show.
Thank you, Bilal, for having me.
Great. Now, we kind of have to go straight to the heart of the matter, which is that you've had a big change in your view on the Fed. You've long been one of the biggest hawks on the street, on the Fed. For the last few years, you were arguing that the Fed would raise rates much more than everyone expected. You were correct. You were ahead of everybody else. But recently, over the last month or two, you started to shift your opinion, and now you've really fully shifted your opinion to be very dovish on the Fed. So perhaps first kind of state, what your dovish view is, for this year, what you think the Fed will do, and then we'll kind of go into why you changed your view.
Cool. So I think they'll cut in the first half, probably starting with 50 in March, and likely 50 at each meeting in the first half. And I think that's it for the year.
Okay, yeah. I mean, that's a very aggressive view in terms of front loading of cuts. But currently, the market and most people expect around 150 basis points of cuts, similar to what you're saying, but over 12 months. You're saying it's going to be front loaded to the first half of this year, which makes you stand out from everybody else. So why have you changed this view? I mean, you gave, in recent years, you've given a very compelling view about why the Fed would be hawkish to do with inflation, persistence, and so on. Why have you changed your view?
So to quote Keynes, and that's a quote everyone makes, especially people who haven't read the general theory, the 500 pages or so. When the data changes, I change my view. There was a very surprising and very stark turn in the guidance given by Chair Powell in December, that I was completely out of step with it. And so it made me look in depth at, what am I missing? And they are much more focused on actual inflation data than I am, much less model driven. And within the inflation data, very focused on core PCE. So I changed accordingly. I'm trying to have empathy with the Fed rather than impose my own ideas of what should or should not be done. And so I had to switch along with Chair Powell. But to be fair to Chair Powell, I think that the deep shift reflects the nature of inflation. That if you look at the data, at least in the US, inflation is either very low or very high. So there is no middle ground. And I think what drove the pivot, this unexpected pivot, was largely the fact that if you look at 6 months core PC, there has been a very sharp decline for most of last year. And so suddenly the picture changes completely. And instead of a risk of not being able to stabilize inflation, I think the Fed was facing a risk that it's actually coming back and fast to the pre-pandemic lowflation, so persistent underperformance of inflation relative to the target. So this is a long-winded way of saying I pivoted along with the Fed, that pivoted along with the inflation regime.
Okay, so what you're saying is the Fed was looking more at recent prints of inflation more than you anticipated that they would, and then on top of that, they were looking more obviously at core PCE, which tends to print lower than core CPI. Is that a fair characterization?
Absolutely.
Yeah. And then the other thing you said is inflation is either high or low. Do you mean that across current sectors, there's some parts of the economy that are experiencing very high inflation right now and some that are experiencing very low inflation? Or do you mean it across time, that over the last 30, 40 years, that's been the case?
More across time, that you really have clusters of prints. And the clusters tend to be, well below 2%. or very high. And this reflects, I think, the BIS view, not the BIS view, but rather this is consistent with the BIS view that itself is driven by the data, that inflation tends to um, behave very differently depending on whether it's in a high or low regime. And once it is in a regime, it tends to stay there. And I think what happened is that before the pandemic, we were in the low regimes, and we had the shock of the pandemic with the associated policy responses, and that moved up from a low to a high regime. And in the high regime, what typically happens, and again, this is shown by the data, is that there is a strong correlation, a strong positive correlation between energy inflation and core inflation. And so we've had this amazing decline in inflation in energy prices, and those are bringing us closer to the low inflation regime, which is the basis for my view on cuts, because um, uh, as you recall, before the pandemic, the Fed was very much focused on pushing inflation back to 2%. That never worked. They've kept rock bottom rates for 20 years plus in the hope that they would hit the target, but they did not. And in my view, it simply reflects um, this fact that inflation gets stuck in a regime, and that those regimes are beyond the reach of monetary policy, which, by the way, won't prevent the Fed from trying to lift inflation.
But what regime do you think we are in? I mean, do you think we are in a low or high inflation regime?
So we're definitely moving lower. The question is, are we going to stay in this low regime? And I suspect that if we have some inflation shocks, for instance, Trump wins and next year, lose fiscal, tariff, clamping down on immigration. So if we get inflation shocks, given that the memory of inflation is still, very fresh in people's mind, and the fact that if you look at the US economy, I mean, the unemployment rate is still close to the lowest ever. I think we will move very fast back to a high inflation regime, which, by the way, is a story of the 1970s. You had an oil shock in 74, half-baked stabilization. Then you had another oil shock 5 years later, and then the inflation rate shot up, in my view, because the economic stabilization between the two shocks was not deep enough. And I suspect that's where we are.
So in some ways, what you're saying is we're seeing transitory disinflation right now.
Yes, because in my view, most of the disinflation has been driven by energy prices. I mean, the labor market has definitely helped. I mean, we've had a couple of positive shocks, if you will. So one of those, I think, is working from home, which American workers have been happy to trade against lower wage increases. The other one has been this extraordinary increase in foreign workers. I mean, Bilal, to give you a sense of how strong it's been, if you look at the labor force in the US at the end of 2019, only 15% of the labor of workers are born outside of the United States. So the share of foreign workers is 15%. Since since then, the increase in the labor force has been about 7 million, and 2/3 of that increase has come from foreign workers. And by the way, in my view, this is a deliberate policy of the administration that counts many distinguished economists among its members, and they could not have forecast that President Biden's promises, payout, and so on and so forth would be yet another demand shock. And so I suspect what went on is that they decided to balance a positive demand shock with a positive supply shock in the form of increased immigration. And that certainly helped to keep wages down. But at some point, we're going to see a recovery. And certainly if the next administration clamps down on immigration, we are going to see much faster growth.
Okay, so on the supply side then, in the past, well, over COVID, we had negative supply shocks. Then last year, we saw a positive supply shock in the form of the labor side. And that, I guess, also helps explain why the unemployment rate was able to stay low and still inflation fell over that period. Because that's been a big question around the Phillips curve, the trade-off between inflation and unemployment. Academics have been talking about non-linear Phillips curve and all of these sorts of things. But your explanation seems to kind of say you should look more at the supply side of labor.
And for sure, the world is not linear. And what's helped the disinflation is that the labor market institutions were geared towards low inflation. So we had almost no indexation clauses in wage contracts. We had negotiation of wages based, every few years, very low union density. So that certainly has, helped contain wage growth. But I mean, those things are not going to last forever. Plus, I would agree that workers' unhappiness, because if you look at real wage growth, it's actually negative. I mean, you have two groups that have done well wage-wise out of the pandemic. Hospitality, leisure and hospitality workers. I mean, since end 2019, their average wage has increased by nearly 30% against an increase in the CPI of about 20%, 19% to be specific. But the rest of the American workforce has done very badly. I mean, the median wage, so the wage that separates the distribution of wages between the lower and the upper half, has increased. At the end of September, it was up 16% against 19% increase in the CPI, plus up to mid-2022. Real wages were actually falling. So no wonder people are unhappy, and no wonder former President Trump is doing so well in the polls. In fact,
I think also there's also, I think, an issue around price levels versus the inflation rates as well. That do you think or not that simply the fact that pricing has gone up and not come back down makes people less satisfied, even if the inflation rate is going down.
So I think people would care much less about where prices are if their incomes had kept pace. And for half of American workers, we know that their wage has not kept pace. I think the economy is looking good because there are so many more workers because of this surge in immigration. But if you look at individual wages and individual income, people are not doing that great, and hence, their voting intention, or perhaps even lack of voting intention, we could very well have an election with a record abstention rates. But it seems to me that there is a real basis for voters' unhappiness. And the thing that puzzles me the most is not so much the numbers, but the sort of liberal punditry surprise at voters' unhappiness. Read in the New York Times, Paul Krugman, the American workers has never had it so good. Which is a bit of a mystery, because if you are running for re-election, it's a good idea to listen to what people think of your track record. And it seems to me that people are not being listened to.
No, we'll come on to the politics in a moment. But before we do that, you've laid out a compelling case of why inflation will be lower, why the Fed should cut. But why should they cut so much in the first half of the year? Most people in the market expect a 25 basis point cut probably starting in March, and then to do 25 at each meeting thereafter to add up to 150. But you're going for this very front-loaded series of cuts. Why this style of cuts?
So 2 reasons: economics and politics. So the economics reason is that if you are at risk of falling into lowflation, you want to be very proactive, because once low inflation has taken root, as the Fed has found out for the past 20 years, it's really bad, really difficult to bring it back up. So the risk of lowflation is already there with the November 6 months core PCE at 1.9%. And based on recent PPI and CPI data, it's likely that December will be even lower. So the risk is there. The policymakers want to be proactive. That's part of their playbook. The second reason is politics. And there you have two views of the world. And I'll leave it to our listeners to decide which they like the more. So if you are less trustful of policymakers, you're going to say that the Fed is out to support the Biden re-election effort. So they want to be proactive because they want to leave enough time for their cuts to work their way through the economy and financial market and to influence voters. If, on the other hand, you have more faith in technocrats, you're going to say, oh, this is the most contentious election since World War II, perhaps one of the most contentious in American history. So I don't want the Fed to have anything to do with this political fray. So I would rather cut before the campaign gets in full gear. We have the Republican convention mid-July, Democratic convention mid-August. The Fed would rather do its cuts well before then.
Okay. Okay, that all makes sense. I mean, in terms of the size, like 350 cuts, I mean, isn't that unusual from historical perspective for them to do so many 50s?
Not really. In fact, Governor Waller this morning drew a parallel with reactive cuts when there is a recession, like in 2008. The cuts were very, very steep. We are talking of cuts that are a hedge against a return to lowflation. So, if you look at what the Fed did in 2019, for instance, I think it was 25 and then 50. So it's quite consistent with what I have in mind. The constraint, of course, that the Fed didn't have in 2019 is the election, and probably the Fed views that they would rather cut well before, things get really heated.
Okay, yeah, no, I agree. Now, on the politics side, you raised this yourself, so we're going to have this conversation. Trump's beating Biden in the polls at the moment. He did very well in the recent Iowa caucuses as well against the other Republican challengers. You talked about voter grievances and so on. I mean, so is your view that Trump is able to capture these grievances very well?
Yes, I mean, not that he's necessarily the best placed person to address them, but I think globally we have seen in many countries, in Eastern Europe, but in Italy, and perhaps even, who knows, in the UK, people losing trust in mainstream technocrat candidates and going for the outsider because, since things have not really improved with the usual crowd, why not give a try to someone who claims to be different? So so I think it's a good part of Trump's appeal.
And in terms of the election results, what is your base case?
So my base case, the Republicans win the White House with Trump, and at least one House of Congress remains Democrat, largely because voters hedge their bets. They are prepared to take a punt on Trump too, but they would rather not put their eggs in the same basket. And so that will put a limit on what Trump can implement. but still, I mean, there is a very strong executive power in the US. So even if it doesn't have the majority in the Senate, for instance, there is still a lot that he could do with deregulations, things that, frankly, businesses will love. So um, I actually expect a positive initial market reaction to a Trump victory.
I mean, do you have concerns? I mean, people often talk about if Trump comes back in, then the US will somehow lose credibility and, term premium will go up and then we run on the dollar and all of these sorts of things.
Uh, Not yet. Let's see. Not just with just the victory. Let's see how things pan out. For sure, in terms of the dollar status of the global currency, there is enormous incumbency advantage. We will need to see, a possible Trump administration, for instance, going strongly after the Fed, because if what I expect, so increased deficit, increased tariff, lower immigration happens, you'll have inflation acceleration, the Fed will have to react aggressively. As we know from previous experience, Trump doesn't take kindly to restrictive or not loose enough Fed policies. So we could have quite a bit of volatility there, and active undermining of the Fed independence, I think, would be very detrimental.
And I suppose Trump will be much more emboldened this time around compared to last time,
Yes.
because he's been president already. He kind of knows how to play the system a lot more, and he'll be a lot more gung ho, so to speak, in his last term.
Oh, definitely. I think this is going, if it happens, it will test, the balance of powers that the founding father had built in the Constitution. It will test the strength of American civil society. And in terms of markets, certainly the impact on the dollar could be quite disastrous.
Okay, great. And just a kind of a final point on the fiscal deficit. I mean, do you think this is something we need to worry about in markets or not? Or is this just something that's there and, every now and then it comes to people's attention, but it's not really a bigger problem? Because one of the things we've talked about in the past is the fact that the fiscal deficit is so large during a recovery phase, which is unusual. So that obviously when you have a recession, it'll be even larger. So we have an unusually loose fiscal policy stance in the US right now.
So I think, it's certainly concerns along the lines that you described, which is basically flexibility is very limited. In terms of how much more debt the US can carry, I think if we have a credible administration with a credible plan to reduce the deficit, because it's crazy to have a deficit at 6% where unemployment is below 4%. It's, my first job out of college was to go to French-speaking African countries with the IMF and discuss stabilization programs with them. And that would typically be the language we would have with them, that their budget deficit was out of control. And the US is in a similar situation now. So I think we can, with a credible administration, a credible plan for fiscal consolidation, I think we can avoid major volatility. But if we have an administration that, suddenly cuts taxes and, claims, as usual, as I always do, that the cuts will pay for themselves, I don't think the market is going to buy it. So this could be, this could be an interesting year in terms of volatility.
Right. Okay. Well, that's fantastic. Now, I did, as usual, want to round off with a couple of one main sort of personal question. Have you seen any good TV shows of late?
Yes, definitely. So I strongly recommend Murder at the Top of the World, it's an interesting story. It's very well acted. It asks some interesting questions about AI, billionaires. It's terrific. Another one I liked a lot was A Spy Among Friends, which is about Kim Philby. And I liked because you see the complicated personality of Philby. Also, quite frankly, the English class system that allowed him to exist as a spy for such a long
So
time.
he was the British spy, the double agent for the Soviets.
Right, he was part
Cambridge,
of
I
this.
think, part of the Cambridge
Exactly,
set. Yeah.
exactly. And again, the acting is terrific. So loved it. I guess that's what comes to mind recently. I am, of course, so busy surveilling the US economy and markets and Fed for Macro Hive. I'm joking. No, these are the two that come to mind.
Right. And what's the best way for people to follow you?
Everything is on Macro Hive. We have a free newsletter which has most of my stuff. So I hope, if there are still listeners who haven't subscribed to our free newsletter, that they will do so.
That's great. And that's excellent. As usual, very sort of comprehensive overview of everything. And yeah, let's see how your view pans out. Let's see how this year pans out with the election and everything. I do have a feeling that 2024 is going to be quite a wild year. So good luck with all of your work for this year.
Thank you, Bilal. It's great talking to you as always.
Great. Thank you.
Thanks for listening to the episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'd be super grateful. Finally, sign up for our free newsletter at macrohive.com/free. That's macrohive.com/free. We'll be back soon, so tune in then.